In this video, trader is going to look at how to deal with a short squeeze from a longer term short trade that you've got on. Stay tuned. Hey guys, a warm welcome to you. All right, so you've got a trade thesis. It's a short thesis. You've had the short on. It's going in your direction. All of a sudden you start to see a squeeze, i.e. it's generally looked at as a steep rally over a period of days. You're sitting in the trade and you can get absolutely hammered by it if you're short on the wrong side of it. So how do you deal with it? The first thing is you've got to look at it as something you can use. So you've got to be prepared for it. It's too easy, guys, I know, to get comfortable in the short. You've got a short on, it's been running for a while. You got this thing just drifting lower and lower. This is easy, this is nice, this is the best thing ever being a short seller. And it's cruising lower, but you've still got to be aware of it because it can catch you out. It can either catch you out when you're shorting at highs or ripping to highs, or it can already come down a lot and then start to rip. In case of some of the retail stocks we've had in the UK have done exactly this, guys. They've been beautiful shorts, they've come lower and lower and lower, and then they've just suddenly doubled in value off the lows very, very quickly before they've rolled over again. Aggressive short squeeze. So what are your options? First one is to ride it out. So this is, some people say this is the right thing to do, and I understand where they're coming from. They're like, listen, you're in it, you ride it out, you sit with it. But I think the trader in me doesn't want to do that. And I think maybe you as well, if you're kind of more this trader who wants to kind of try and time things, sometimes we get it right, sometimes we get it wrong. If you can formulate a plan to use it to your advantage, I feel that's better. Now, if you've got deep pockets, you're prepared to sit through it, ride it out, and prepared to kind of do whatever it needs to be done to stay short, then fine. But let's look at some other alternatives, shall we? So the one is to cut it early. Now, easier said than done to identify a short squeeze, but when you start seeing good, strong rallies that are unusual, and again, it comes down to price action, doesn't it? It comes down to looking what's unusual. If you've been seeing grinding lower, red, slight little green maybe, but then grinding lower, then all of a sudden you see a strong kind of big green move, maybe a big engulfing, bullish engulfing candle or something, then maybe that's the time to cut the short. So you know what, I'll cut the short. If I'm wrong, it's just one day, I can re-enter on the low. It's only one day I've lost. But maybe cutting that short in anticipation of a short squeeze is a good thing, because you can live to fight on another day here. Whereas if you're, perhaps if you're in the middle of the trade and it's not quite light profit and it could go against you, at least then you're ready. And the good thing is, guys, is what I've put here is use it. Because if it's going to be a short squeeze, it's a good opportunity for you to get back in on the short side at a great price. So the idea of the short squeeze is that the average short punter has been flushed out. That's the point of it. The point is they know that a lot of people are short. They know that there's a lot of short interest. They know it's bearish, and I'm saying they, don't mean to say they as in there's a conspiracy here, but people know this. And if there's a lot of aggressive buying coming in, they know that there's a lot of people vulnerable, or buyers know there's a lot of people vulnerable who are going to cover the shorts and are going to cause a squeeze. Now, we often see this at highs as well. So all-time highs, so we see a squeeze at highs. There's a lot of people stuck short in it, so it doesn't always apply if it's gone down. I use that analogy that some of the retail stocks in the UK have done that, pushed down, short, squeezed higher and gone lower, but it could also be at fresh highs. You know, we see something squeezing higher and higher and higher and higher. Example right now would be something like Beyond Meat, or we had Tilray, these kind of things, you know, where very, very high borrow costs, but the average person's ridiculous, incredulous at the price, and it's just squeezing them because they can't stand it. And the squeeze means that those are the guys who are fueling the upside because they have to cover the short positions by buying. So if you think that's what's happening, you know that it will end at some point, you're in a powerful position because you can look at it objectively and say, hey, great short, price action at the moment is not conducive to shorting this. Let me wait, let me be patient, let me strike when I'm ready, let me be sniper-like with this. So wait until your average short selling punter is out. Everyone's piling in, you're out, then maybe the sentiment changes, maybe it's more bullish, it's like, oh, this is great, blah, 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 blah. Not so active on the average bulletin board or Twitter or finance app or whatever it may be, saying how great of a short it is. It dies off, the interest dies off, and then all of a sudden they get flushed out. Now we can have normal service resumed. So consider the re-entry when the borrow percent is lower. When it's a crowded short, and something maybe to stay away from, if I'm honest, are these crowded shorts. You can tell a crowded short by obviously how many people are in the short position, which you can find out on Finviz, but also the easier thing is how much it costs to borrow the shares. If it's very, very high, then it's super crowded. A lot of people want to be short on it, and that means everyone's in it. And generally when everyone's in it, you know, does it work? Okay, it can do, and you see sometimes these, you know, frothy stocks that will eventually roll over, but the cost to borrow is extortionate, absolutely extortionate, and it's a different type of play. It's attracting people who aren't normally shorting, but because everyone will see this and it's brought to their attention by other people and media, etc., all of a sudden they become kind of want to get involved in the short side. They're the ones that end up fueling the short squeeze. So consider kind of initiating the short when the borrow is a bit lower and it's less crowded, because a crowded short trade is a deadly place to be, guys. Right, number 5, stay away from the low float stocks. Pretty much a golden rule. Those low floaters just can be brutal, and that's what we've seen with some of them recently. Low float, people getting short on it, and it's just hammering them. We're just seeing massive rallies off it, and yes, will it eventually end in tears for the stock price? Most probably, but timing, it's a different matter, especially short. Can you sit through it going up 300, 400, 500%? Probably not. Would you want to? Probably not anyway. So there's no free lunch there, and staying away from those low floaters is key, because those are the ones that can really rip. And waiting for the back end of the move. So while the flushing out the buyers is going on, the short squeeze is going on, then look to wait for the rotation back down off that. So wait for the short squeeze to end, pull down, maybe one more try, and let the whole thing die out. The euphoria, the kind of headline stuff, let that go, and then look at it purely from a kind of methodical position, and like, hey, I'm going to execute this. I'm waiting for all this hype and stuff to go. It's up, it's down, it's back up. Starts to not be so important. Other headlines take place. There's your sweet spot, because you've already got a premium what you believe was a short price, good short price. Maybe it's not right at the peak. Maybe you're not getting involved in all the hype and all this, so you're not a hero for selling the top tick. But everyone's flushed out of it. The whole play's gone, and now investors aren't going to be buying. What you want is a position where new buyers won't buy it because it's not considered value. You want the shorts to have been flushed out, so they're gone, so that's not creating any more fuel to the fire. Investors don't consider it as value to buy here. In fact, the opposite. They see it as an opportunity to sell their holdings if they haven't done already. So the volume is decreasing, and now you start to see that steady decline back to a mean, whatever that was. So that's a better way, in my opinion, of dealing with a short squeeze. Utilize it, recognize it, and trade whenever the hype's done and dusted, the dust settled, you've still got a premium over price, it looks like a good opportunity, you can strike, and then you can frame the trade against those highs if you're wrong as well. So it's a good place to put the stop. Hey, it's going to be off that swing high, the last swing high, or whatever it may be. It makes things a little bit easier to manage than trying to stab short when it's up aggressively, because you just don't know when it's going to turn. It could turn at any point and leave you vulnerable. All right, guys, so how to deal with the short squeeze? Let me know your thoughts on that one in the comment section below, and I'll see you in the next video. Take care. Bye-bye.